Global Trailblazer podcast with Farah and Ken. And we are very grateful today to have Mr. Adrian Mendoza, who is the founder and general partner of Mendoza Ventures. After having two VC funded startups in Boston, Adrian started Mendoza Ventures to address the funding gap in the pre seed investment stage for underrepresented founders. He launched his firm in 2016, focused on investments in AI, fintech, and cybersecurity companies. Mendoza Venture is minority and women led, as well as the first VC firm in the East Coast founded by a Latino. Yes. The firm is currently raising its third fund, and its first fund is the top quartile of seed stage funds. Also, good tidbit here is that Adrian is the author of Mobile User Experience, a book on mobile user experience published by Elsevier. Did I pronounce that right?
I think Elsevier.
Elsevier in 2013, adopted industry wide as the standard for mobile user experience education, and the video series CSS for Designers, published by O'Reilly. Wow, on 2015. That's great. Adrian earned his bachelor's from the University of Southern California, USC Trojans, go Trojans, and his master's from Harvard Graduate School of Design. Adrian, it's such an honor and pleasure to have you. And Farah and I are grateful to have you on the Global Trailblazer podcast series. Thank you for joining us today.
So I guess I'll go with the first question
Yeah,
that we
go
have
ahead,
lined
Farah.
up. Yeah.
Let's do this. Let's
So
get this
Adrian,
going.
on your funds, what are your prerequisites for a potential investing company to prepare before they go and see you?
Yeah, that's a really good question. One of the things, having been in VC for now about 10 years, raising 5 years, raising funds for my own companies, there had never been enough transparency in terms of what a firm or a fund would look like. And so one of the things, if you go back into our own blogs really early on, I would say like January 2016, we actually put it out there. We said, this is what we're looking for. We're looking for companies that have raised a friends and family before, so that someone other than grandma has written you a check. That you have to have a real product to market. So there has to be an MVP product, and there has to be a paying customer. And that's really important for us, because so much of being in startups in the entrepreneurial journey is a lot of companies being a solution looking for a problem. And we use that important piece of talking to the customer to validate them. And it has to be a customer that's in the pipeline, so that there's a little bit of revenue, so that the market is saying, yes, we figured out how to price it. We figured out what the cost will be. It is in a pipeline. And that was really important for us to get that out into the world, to say, not only are we going to invest in these three sectors, but we're also going to look at these three sort of checklists. And really, when you get past that, you also have to find entrepreneurs and founding teams that are looking for a very, very hands-on investor. We are going to be very active with the company. We're going to meet with you on a weekly basis. We are going to help you put funding rounds together. And we have to make sure that they know what they're getting themselves into. That this isn't a passive investor where it's a check and we walk away. We're going to be really, really engaged with the entrepreneur and the founding team. And that's one of the sort of the last important check boxes in due diligence is, do they understand what they're getting themselves into? Because we've got a lot of people that have done due diligence with us and say, whoa, this is not a traditional venture fund. And we say, yes, we know. And there's other people that will come in and say, that's what I'm looking for. I'm looking for a partner more than an investor. And that's really, really important for us.
Oh, that's awesome, Adrian. So far, how many MVPs have you developed through your investees? And could you share with us some of your investment portfolio stories?
Yeah, so we are now at about 11 portfolio companies. 2 out of Fund 1, 10 now, actually, I'd say about closer to 12, 10 out of Fund 2. In Fund 1, I think the best story we have is our second investment was a cybersecurity company founded by 2 Latinos here between Boston and Austin, Texas, and we got them acquired in 5 months, along with only had one customer, which was TJX. And for those founders, it was life-changing, for us, it literally told us we were onto something, because this was early 2017, before the hype on cybersecurity, and it returned a 10x back to us. Diverse-led founders returned a 10x back to the fund, paid out over the year. Like, how much it was really, for us, it was like, we're on the right thing. This works. Our first investment in Alice just raised a Series B from General Catalyst and a few top tier VCs at about $130 million valuation. We invested when it was $5 million, early on, and have now co-invested with some of the top tier VCs on the East Coast and the West Coast. And really, for us, it was, again, diverse team, really coachable founding team. The CEO I met, probably one of the first CEOs I'd actually had pitched me in early 2016, when we were just getting Fund 1 off the ground, and came to me and said, hey, I've never done this before. Can I buy you a cup of coffee? And this was in May of that year. And I gave him an amazing, literally roadmap. This is where the story is going to go. Followed the roadmap to a T, raised his first pre-seed funding round in August when nobody closes. A year later, did a C round. A year later, did a Series A. And then just recently did that Series B. And so it's really amazing for us to be able to see that the work in being hands-on, we saw this direct correlation between the more time you put into a company, the more the valuation goes up, because of who we're making introductions, how we're sort of helping coach them, and being able to fill in the skill set gap. That as you go from funding round to funding round, it's not like there is startup university where someone's telling you where the movie's going to go. For a lot of these founders, they've done it, but never done it before. For diverse founders like us that are in this panel, it's not like there are examples upstream to go to say, hey, how is this done? Because there's very few people of color that have, broken the barrier of a Series B or Series C or even IPO'd. And so to be able to be that network of experience to help them is really, really important, because even in Fund 2, we hadn't even closed Fund 2, and we already had some early markups and some amazing co-investors in some of our deals. We've had Barclays co-invest with us. We've had Luge Capital out of Toronto, New York funds, Silicon Valley funds that are really coming in to say, and pulling us into these deals to say, you guys are domain experts, you know this space, but you're also bringing something to the market that doesn't exist out there right now.
Oh, that's very impressive, Mr. Mendoza. Seriously, you did mention 10x just now, and I was just very curious. Most VCs have this growth stories committing to 3x or 10x or something. I did hear 100x some, And what is your target, and would you share with us how you get your companies to 10x?
Yeah, so funny enough, when you look at the traditional VC model, the traditional VC model is based on a 90% loss and 10% unicorns. Most VCs, scoff at the 10x, and they're like, oh God, a 10x, a 5x, we don't want that. We want a 20, 30, 40, we want 100x. But the reality is, when you look at the spaces that we're investing in, we're looking at fintech, AI. When's the last AI company that IPO'd? None. They've been all early acquisition. Other than the occasional carbon black, that's an outlier. 99% of cybersecurities are early acquisitions. There is excitement now in fintech. The majority of fintechs are early acquisitions in the sub 200 million, now maybe in the sub $400 million range. I like to say, if there wasn't a market for early stage M&A, Steve McLaughlin and FD Partners wouldn't be making piles and piles of money, doing M&A transactions for fintechs. And so for us, the traditional model is, I'm going to, a fund of our size would be doing 40, 50, 60 investments. We're only making 15 in our early stage fund and 12 in our growth stage fund. We're about very defined portfolio, being very engaged. And I like to say, because I'm an American, I like to use baseball anecdotes, that singles and doubles wins the ballgame. When I modeled it out, the 90 and 10% on 40, 50 deals, and then modeled it out, an IRR for our fund on, I have 4 companies that go nowhere, 4 companies at 5x, and 4 companies at 10x. We're literally exactly at the same 33% IRR that most of the big funds say that they're going to do, and the same multiple on return. And it all evens out. So it's like, it's great if you're like a night, if you're in the 10%. It's awful if you're in the 90% of loss that VC is going to encourage. So why are we going to build a 90% loss ratio when, great, I'll do a third loss ratio and then do sort of smaller, earlier acquisitions, so that, when by the time we get to year 10 of the fund, we're starting to, farm out and harvest our 10x's, versus those investors that, are looking for the next Uber or Lyft. That's a 15 to 20 year time horizon. And truth being, I want to see distributions for myself and my limited partners by year 5 and 7, and then be all done in year 10 and say, let's do it again.
Wow, that's really amazing. I'll pass the floor to Ken for his questions now. Thank you, Mr. Mendoza, for the questions.
Thank you, Farah.
Thank you, Adrian. No, we enjoy your stories, and it leads quite nicely into the fund mix and concentration, where one of the biggest challenges that most of the VCs have is trying to maintain the mix. You talk about the 10x, being able to maintain that. I agree with you about the singles and doubles approach. Instead of going for the home runs, which some people like to hit the home runs and go at 100x, the idea is to be able to do it where it's reasonable growth within a period of time. But one of the biggest challenges that I'm seeing, and Farah, you can also relate to this yourself, is being able to maintain that mix as you grow. And mix, in a sense, is in terms of not just focusing on just, in your case, cybersecurity, AI, and fintech, but are you open for other flexibilities to other industries? And if you are, what does that look like going on in your next funds?
Yeah, I mean, Ken, that's a really good question. For us, when I took a look at having now been in VC for 10 years, and I don't want to poke holes on anyone's investment thesis, but because there's some great investors out there. But, early on, I would have a lot of conversations with some of the Valley VCs and the New York VCs. And, their strategy is they would get into a company and then learn about it and learn about that space. And they would go to me and they're like, you're a smart guy. You can learn femtech or other spaces. But when we put Mendoza Ventures together, there were 3 things that always bugged me about venture. And it's funny because they're not the case in private equity. The first one is one I talked about, these large, broad, overreaching portfolios that, there's just no way you can maintain, what are the KPIs and who are the teams and CEOs on 40 to 50 portfolio companies? No one can. Like, you just can't. Like, I had talked to GPs that had no idea that they had invested in a company, or had actually how much they had led the company with. I know every funding round we've done. I know every name of every CEO. I know exactly like how much cash is in the bank. The second one is location agnostic. And, for us, traditional VC is the Valley invest in the Valley, New York invest in New York, Boston invest in Boston. Is we said, look, we can stay in the same pool that we are, or we can also start looking for the best and brightest minds and companies and ideas, regardless of where they are. The current Fund 2 portfolio is across 3 different countries, 4 different states in the US. And what's really nice is last week I was on a call with LPs. That now mixes exactly what our LP base is. There were 4 different countries of LPs in one of our calls. And it was perfect because for the LP, the limited partner and investor in the fund, they're getting access to deals that, if they're local in Boston, they're getting access to deals in Silicon Valley. If they're in Ireland or Australia, they're getting access to deals in the US or Canada. And so the third most important one is that VC is traditionally a black box for the LP. And I had these interesting experiences where I had raised VC money, and years afterwards, I had people approach me and say, hey, I was an investor in your company. And I was like, who are you? And like, I've never met you. And this guy would be like, I invested through this fund and I invested through that fund. And my answer to that is, had I had access to you, it would have been life-changing. And for me, one of the things we did with Mendoza Ventures is we broke apart the black box, and to create transparency between the limited partner and the GP, as well as the founders. And so why that's important is to be able to, to leverage that domain expertise of men and women who have spent 20, 30 years in financial services, in AI companies, in cybersecurity companies, and tap their expertise on due diligence, on sourcing. And really why that's so powerful is when we looked at how to de-risk venture, because PE does this all the time, we're going to invest in spaces that we know really well. We're going to invest in spaces where I know who the fund, who the next funder is. I know who the potential customer, I know who the potential acquirer. Because when I looked at venture, it said, how do I de-risk what we're building? One, we're de-risking it by being very hands-on. We're going to de-risk it by investing in spaces that we know so much about, not just maybe personal experience, but experience from that network. So perfect example, like we have looked at IoT deals. I have no experience in IoT. I should not be investing in IoT. Same thing goes with healthcare. But if we end up getting an influx of IoT professionals, healthcare professionals that are coming in to join that expert network, then that opens us up directly to have that domain expertise to be able to tap into for due diligence, for what does a competitive market look like. Because that's really, really important, is when we look at the guidelines of where we're investing in, everything, even within fintech, is we're looking at spaces where we know exactly who that next customer or that partner is. And so, it's a really good question in terms of, I would love to invest in other spaces if we had that domain expertise in-house. And it's really hard because there are a lot of amazing entrepreneurs and companies out there. But, if I'm investing in a space where I'm dumb money, it really is like going back to traditionally how VC works. And for us, it's really, really important to maintain, if I can't provide value to the company on a weekly basis or on a board basis, I have no value writing them a check. And that's really one of the important things that we maintain. And this is why we always will keep an early stage fund, because part of the power of an early stage fund, of a smaller fund, is a lot of flexibility on changing the mix. So our firm growth strategy is build an early stage fund, sub 15 million, sub 20 million fund, made up by accredited investors, by an expert network, a growth fund made up by large qualified purchasers, institutional capital allocators, and then do it again. And always maintain this mix of, early stage fund, growth fund, early stage fund, growth fund. We use the early stage to build a cohort. And we also have the ability to change the mix, so that in fund 4, if we decide that, right now our breakdown is 60% fintech, 30% AI, 10% cybersecurity. For the growth stage fund, we're actually starting to relook at that mix and be like, there's an amazing pipeline right now from where we are in the world of cybersecurity. Cybersec has gone from the thing nobody talks about to now DevOps and DevSecOps and threat intelligence are now popping up in not just the SMBs, but in government and large enterprises. We're looking to change that mix to now be about 30% cybersecurity, 10% AI, and then 50 to 60% of fintech. And then when we, if that trend continues, then we might see a total flip in the early stage, the next early stage fund, of a much larger allocation of portfolio construction into cybersecurity. And so that's where the power of these small funds allows us to see flexibility in portfolio construction, Because one of the trends that we saw with the larger funds is larger funds go from 5 million to 10 million to 50 to 100 to 250 with the same investment thesis. And then what happens at the end, they have an inability to source deals because they can't write a $500,000 check anymore. They're now 100 to 150. They have to write 5 to 10 million. And what's happening in this market, by the time they want to write that 5 to 10 million, most of these rounds are insider rounds.
Exactly. Exactly. And I like the fact that you became more the subject matter expert in these companies. I think that that's what's missing in our space is that VCs are not taking the time to learn about the firm itself, the strategy of the firm, and how that firm needs to segment marketplaces. So you became more the subject matter expert. And you're absolutely right when it comes down to cybersecurity. I was at recently at the event here in New York, the SALT conference. Big shout out to Anthony Scaramucci and Skybridge. It was very, very successful. And you're absolutely right, Adrian. Cybersecurity was one of the big things that were being discussed, other than blockchain applications. So the avenue that cybersecurity is growing because people are using more big data, exposes that cybersecurity risk, and those companies are now given the opportunities to receive that capital. But most importantly, you hit it right on the point that you're starting off at a smaller round, but it gives you the opportunity to grow up your portfolio as you go to the next stage. And you become that subject matter expert. So you know what's happening within the company. You know how the company needs to grow to the next stage. And this is what we need to do better in the VC space. But you led very well into a question I want to ask you about limited partners. And you and I talked about this before, about the limited partner concentration. We were fortunate to have Eric Bolin on the show before, on the podcast. And Eric, respectfully, is one of your LPs. And one of the things that stuck out with Eric is that relationship that he had with you. And one of the things that Farah and I, as we build up our funds, the avenue of finding the right limited partner who not only believes in your investment thesis and strategy, but also builds a relationship with you. If you can share some wisdom, nuggets of wisdom on how you were able to find those limited partners. I know that right now you're building for the third fund. What is it that you do? What criteria you look for in terms of trying to determine who's going to be your next limited partner and how much are they going to invest in your fund? Because there's a fund concentration there that you don't want a limited partner to be overweight. And you and I talked about the overweightness.
Oh, we have talked about this, I think, till the cows come home. But I think you bring in a really, really good topic. And one of the most important things when we were just starting to build Mendoza Ventures, I had a few really good sort of fund managers that had known me since I was an entrepreneur. And a lot of them, were telling me these stories of that, they were younger managers and LPs would come in and say, well, you don't know what you're doing. Let me take this away from you and run it. And it was like, wait a minute, like, this is what we're doing. And I kind of like, it stuck with me about it. And one of the things that would come up these conversations, and early on we had these conversations, is this is a 10-year relationship for a fund, traditionally for a fund. This is a long-term, building of a relationship that you're going to find. And for us, the most important thing is when we bring in a limited partner, especially in the early stage fund, we're looking for those that understand that we're building an expert network, that the goal is to find an active limited partner. 99% of our limited partners are actively working in the space, other than one guy who lives on a boat, which, you know what, I would hope that one day we're all living on a boat and emailing your fund manager for your K1 and that's it. They're all actively working in the space. And one of the things that when we look for people is we look for people that fit the criteria of domain expert, but also are a great, amazing person. When we bring in a limited partner, we literally go to them and say, welcome to our family. Like, you are joining our family. We're building a 10 to 15 year relationship. It might even be more. And because really the critical part is building a base of individuals. It's one of the things I think a lot of new fund managers don't get the base that you build is a base that's going to be with you for not just one fund, but potentially 2, 3, 4, 5 funds. And you want to make sure that they're very active and that they're also coming into this eyes wide open. And that's really, really critical because, we've turned limited partners down. We've done it 3 or 4 times. And we've turned people that were just like, people were walking in and saying, oh, well, you don't know what you're doing. Why don't you give me the list of all of your limited partners before I come on? And it was like, no, that sounds sketchy and weird. And it's right. We had someone who literally asked about what the immigration status for one of our Brown founders were. And I literally responded and said, no, I don't want your money. But I have $250,000. I want it. Nope, don't want your money. Please go away. And, one of the things is we built this amazing network in the early stage fund of men and women that are professionally and personally networking with each other.
Wow. What a beautiful way to end it. I'm not going to say much. I don't think I need to say much. Other than that, for our viewers, what's the best way to reach out to Adrian Mendoza? Because our viewers include venture capitalists, limited partners, founders. What's the best way to reach out to you, Adrian, and the Mendoza Venture Fund?
Yeah, there is, reach out to me on LinkedIn. We've had several people reach out on and say, hey, I'm a Latino or African-American looking to get into venture. We get decks coming through LinkedIn. We also have our website where we have a thing of I am an investor or I am an entrepreneur. And we have had inbound leads from LPs that are like, we're excited to talk to you and what you're doing. And so if you're an LP, a founder, or someone that wants to learn about, VC, reach out on LinkedIn to me personally, or reach out through our Mendoza Ventures, Mendoza-Ventures.com, and go to our contact page. And we usually try to respond to everybody, even though we do get swamped, but we're happy to talk and share and learn about what we're doing, and always happy to share about, what our journey is, and, also what we do for a living. And, especially for those that want to be limited partners, we're really are changing the face of venture capital, and we're looking for people that want to do it with us.
Adrian, Farah and I are always grateful to have you on the podcast. We thank you very much for sharing your wisdom, your nuggets of wisdom in terms of fund management and what you're doing at Mendoza Ventures. We will definitely be in touch with you. Farah, you have anything else before we go away with the win?
Yeah, it's a definitely massive amount of learning and insights shared by your good self, Mr. Mendoza, and also Mr. Goodwin. Is a lot of sharing and insights learned all through this podcast. And just to touch on a little bit on investment management side, I have like a strategic partner that can actually help on that to automate all the reportings. So would love to stay in touch so we actually can help each other and automate and digitize our funds. Yep.
Yeah, I would love it. Thank you, Farah. Appreciate it.
Thank you.
Adrian, I want to thank you so much for being on the podcast. As we always say at the very end, we are always grateful, and we are always trailblazing.
Awesome.
Always grateful, always trailblazing. All right.
Always trailblaze.
Thank you. All right.
Bye, guys.